Welcome to this session in which we will discuss value creation in the context of integrated reporting. In the prior session, we discussed integrated reporting and integrated thinking. And as we are discussing integrated reporting and integrated thinking, we kept mentioning a keyword that state value creation. And I said that don't worry, we're going to define value creation in the next session. And in this session, we'll focus on the term value creation. So what is value creation and integrated reporting? It refers to how an organization generates, sustains, and enhances value for itself, because the company need to do what? Need to generate value, return, growth for itself and its stakeholders over time, and not just financial performance, financial and beyond financial performance like social and environmental factors. So in this session, we'll focus on what is value creation. First, we'll talk about the company itself and what is value creation that the company generate outside itself to its social, environmental, community environment. Let's go ahead and get started. Before we proceed any further, I have a public announcement about my company, farhatlectures.com.
Hello everyone. Are you struggling with your CMA exam preparation? Do you feel that your review course is moving too fast, too brief, or not covering topics in depth? Well, if that's the case, at Farhat Lectures, we can help you. We build your confidence through in-depth explanation, not memorization or reading the slides. What we will do is we provide baby steps approach to break down complex topic so you can truly learn, understand the material. How do we do so? We offer video lectures, we offer practice MCQs, we offer true-false questions, we offer exercises, we offer the notes. Understanding the material is the first step in passing the exam. Once you understand the material, you have gained the confidence to pass, and you can pass with Farhat Lectures. What can you do now? Start your free trial. You have a 2-day free trial. Take a look at it. Give us a chance. Your risk is zero. You like it, you keep it. You don't like, you cancel. Give us a chance. We can help you pass the CMA exam.
So how does the company create value for itself? Well, when the organization generates sales, generate profit, it create value for the shareholders. It generate value for the shareholders in form of revenues. But remember, every time we sell something, every time we sell an item, what do we have to do? We have to provide a service. Then the customer, we sell something, the customer gives us money, but we provided a service or product to the customer. So what happened is, technically, every company is in a win-win situation with its customers, because you sell the product. For example, Farhat Lectures. I am selling a product to you. I'm selling you the preparation for your professional exam. That's my product. As a result, I'm generating value for myself, the monthly subscription. You, at the same time, you're getting a service, you are getting a product where you pass your exam and improve your career. So I'm generating a value for myself, you're generating value for yourself. So this is how you can both benefit, value creation. Now, this transaction impact not just the organization financial standing, it also influences its reputation and its relationship with the stakeholders, customers. Anyone outside the company is a stakeholder. Now, let's think about Coca-Cola as an example. When Coca-Cola sells its beverages, it generates value for itself when you pay them the money. That's the value that Coca-Cola receives. At the same time, customers receive value, whether it's enjoyment, refreshment, convenience, that caffeine kick, whatever you want to call it, whatever that value to you. When you purchase the Coca-Cola, you got value in return. Also, what Coca-Cola did builds a brand loyalty and strengthens its market position, contributing to its long-term revenue, because as it sells to customers, more customers are happy. They will tell other customers, and everyone knows what Coca-Cola is. So this is how Coca-Cola create value for itself and at the same time for its customers. So it's a win-win situation. Now, sometime Coca-Cola will, not sometime, also the organization can create value outside of itself. Well, as the company operates, they don't operate in vacuum. They operate in a broader social environment. And the effect of their transaction, referred to connectivity, can impact the organization's social license to operate. Now, when Coca-Cola produces those beverages, when they produce the sodas, when they produce their product, they don't produce them on the moon. They produce them in a certain community. They need those resources. Now, the community itself will have to welcome the local government, the local council, the people in the community. They have to welcome Coca-Cola. This refers to the acceptance and approval from the community and stakeholders that allow the organization to continue its business activities. If the value created for the organization or its stakeholders is significant, it should be reflected in the integrated report. So if you are creating a value and it's significant, you have to show these things in the integrated report. And that's one of the challenges we'll talk about later. What is significant? What is material that we need to include and what's not? So also, what's significant that's affecting both short and long term, and obviously medium term. So if we look at Coca-Cola as an example, beyond the financial, beyond the sales that they make, Coca-Cola's reputation is influenced by how it interacts with its stakeholders, customers, suppliers, the community where it's operates. For example, Coca-Cola commitment to reducing plastic waste and using more sustainable packaging directly affect how the company is viewed by which group? Environmentally conscious consumers and organizations. This is one example of how they're creating value through their act by making sure to reduce plastic waste. Now bear in mind, sometimes those externalities, those value creation could be positive, could be negative. They want to have more positive. There's always a trade-off. What is the trade-off? So if Coca-Cola is selling beverages, yes, they're selling you enjoyment, they're selling you refreshment, but at the same time you have the consumption of sugar. The consumption of sugar is basically a negative for the health of the consumers. So you have to take that into account. So positive externalities for companies like Coca-Cola would include employment opportunities, economic growth, and in the communities where they operate. Absolutely, they're going to create jobs, they're going to create more income for that community, but also you're going to have more plastic pollution and water consumptions. Those are significant concern. Also the health concern. Again, the health concern for the consumers that consume Coca-Cola product. It's sugary product. So for example, in response, Coca-Cola has committed to sustainability goals such as recycling the equivalent of 100% of its packaging by 2030. That's what's part of their goal. These externalities are vital consideration in the company's integrated report. So you have to show the positives, but you also have to show the negatives. Again, what's the difficulty we'll mention later when we look at the report is what should I include and how much should I include, whether it's a positive or negative, because that's going to influence Coca-Cola's environmental impact and its long-term sustainability. Let's take a look at this multiple choice question from farhatlectures.com. A beverage company produces plastic bottles which are later disposed of by consumers and contribute to environmental pollution. This is an example of what? What type of example, what type of situation this case is illustrating? Is it a positive externality, a negative externality, manufactured capital, intellectual capital? What would you say that is? Well, what's going to happen is this. The company is selling those plastic bottles. They're selling their beverage. That's a positive externality. Well, not positive. That's creating value for the company when they sell those beverages. But what's happening? People or consumers are doing what? They're later disposing of those plastic bottles and it's affecting the environment. The trade-off here is now you are affecting the pollution negatively. It's a negative externality. Now, what is a positive externality for this beverage company? If this beverage company employs people in the area, then this will be a positive externality. But since those plastic bottles are being disposed of, it's a negative externality. Now, in their integrated report, the company will have to mention both and how they're mitigating negative externality, but they want to make sure you are aware of them. So the answer is B. Now, you also want to make sure what is C and what's D. Manufacturing capital refer to physical asset like factories, not external effect like pollution. Same thing with D. D is intellectual capital, which is a different type of capital. This is knowledge-based asset, like your intangible asset, intellectual property. What should you do now? You want to go to Farhat Lectures, look at additional MCQs, especially if you're studying for your CMA exam, CPA exam, or other accounting or finance courses or certification. Invest in yourself. Farhat is always here to help.